let's talk about the top 5 things that I was asked this week from people like you who are in Denver getting pre-approved to buy houses in the spring of 2025. First thing, which was really interesting, came up yesterday. This is somebody who collectively they have a sizable amount of money saved for a down payment. They make good money, college educated, etc. So just building out the framework. And they asked me, Ray, should we go direct to the seller to buy the house? My brother said if we do that, we can save money, we could be in a better position, and we might get the selling agent to help us get our deal accepted. Very valid question. Those of you that are aware of this real estate settlement, the NAR settlement from 2024, it is something that's out there. Then more so, I asked them to challenge their thinking. And the reason I said that is I'm not to say you should or shouldn't. Real estate agents, definitely the really good ones, are worth their weight in gold. Just simply are. How long has the selling agent known the seller? I will just ask you that question, because then you got to think about allegiances. You got to think about where are they going to be trying to do the best for and buy, right? Hey, Ray, will we get a better deal if we go direct to the seller? Let's be honest. There's actually already an agreement pre-existing on how much the seller will pay in total in commission to sell their home, subdivided out by how much to a buyer agent and the selling agent. So it's not to say you're going to save money necessarily. My opinion is, if you're thinking about that, do more research, ask questions, and then decide if you should go direct to the seller. This one is very easy to answer, but it did come up, and it comes up actually quite a bit. I'm kind of surprised, but I think it's because we're now in a time where people who are buying had family members that probably bought at times when there were prepayment penalties. So the common question becomes, are there prepayment penalties on the mortgage? And the answer to that is, if you're doing a standard mortgage for your primary residence, they are not allowed. If you're an investor qualifying off the debt servicing, or that known as that DSCR loan, it's pretty much the standard, okay? So loan specific, but rest assured, if you're a primary resident buying a home using a traditional mortgage, you're looking at, on average, a 30-year fixed, but there are not prepayment penalties, okay? Somebody then asked, what do I do about the thought of putting extra money to the mortgage every month? So with that, I can say this, because they talked about budgeting, they talked about being able to make the payment in a timely fashion, and Ray, does it pay down the house faster? It's pretty clear. It's pretty easy. You can Google this stuff, but it's referred to more commonly as a biweekly mortgage, okay? So if you're paid 26 times a year biweekly, this can really help you for budgeting purposes. You would end up having half your payment taken out of your account, and therefore one extra payment per year is what happens in that example, okay? What does that do to the mortgage? In short order, if you send one extra payment a year, and the numbers are not far off if you do just a 13th payment, or if you do it every 2 weeks, that you're going to send one extra payment a year. The principal is applied after the interest is paid for that month. Therefore, the numbers work out very closely between doing it biweekly or one extra payment a year. That is, you will save about 4.5 to 5 years on the life of your loan. Bear in mind though, are you going to live there that long? It can be, in my opinion, a forced savings plan, because you're paying the loan down faster. Therefore, even if you sell in 5 years, 7 years, 3 years, you will owe less. Therefore, your payoff will be less and you will walk with more proceeds. So if you like the idea of a quote unquote forced savings, it's a great concept. Yes, you will pay less interest over the life of the loan, and over time, less interest per month, because you are paying more to principal. In an amortized mortgage, that's how they work as well. So from there, they said, if we're pre-approved for X and we want to buy a house that's more expensive, what does that mean? Does that mean we just put extra money down? And the answer to that is yes. And it's almost like it takes a quick second to think through this, because if you're approved for a loan amount of $450,000, and let's say that's based surely off debt ratios, the reality becomes, if the loan does not change from 450, if you just put an extra 50 grand down, the house price can go up $50,000. Of course, the question becomes, what is the best use of that money? And if it is, as they said, to maintain our lifestyle rate, we simply just like to go out to dinner, by all means. if that money is better served so that you can maintain the lifestyle with vacations, great dinners out, going out, etc., to live in this beautiful state that we call home here in Colorado, ski weekends, which are expensive, then by all means, put the extra money down. But think through what is the highest and best use of that money. I could stake a challenging thought to that argument to challenge someone's thinking about it of just put the 50 grand in the bank, draw interest off of it, low risk investment, and then subsidize because it's about $250, $300 a month higher in payment. 300 divided by 50 grand, that's a lot of months that you could in fact have that money earning interest for you versus just putting it down on the house, therefore working in another vertical for you to grow some wealth through interest earned if you were investing the money. So what is the opportunity cost putting that extra money down so that you maintain the same mortgage payment? So what I'm getting at there is what I've talked about before. So check back prior videos about what I would call the subsidization of lifestyle, which is related to putting more money down to maintain the same payment versus putting that money in the bank and then just transferring the delta every month for the mortgage payment. So now let's talk about the direction of interest rates since last week when I talked about this. And here we are, the CPI, the inflation report came out this week, and we are seeing some very interesting trends relating to mortgage rates as a result of what happened. And that is the last 2 days, today included, mortgage bonds are rallying. I think between today and yesterday, we're almost 100 basis points. That doesn't mean interest rates have come down 1%, y'all, but it's a dramatic change. What's most interesting about this is now we're seeing that we might see a run, and I'm thinking about this as the hangover effect. What do I mean by the hangover effect? Simply that, I said 8 out of the last 10 years, mortgage rates had gone down this time of year, and this year they did not. However, May of 24, rates went down up until October. So is it just delayed? And this most recent inflationary data is going to cause mortgage rates to come down? Time will tell, so stay tuned there. If there's anything specific that you want me to talk about, definitely, if you want to have a conversation, callaway.com/mortgage maestro. Make sure to check out other videos we have on the channel. I'm constantly updating the information. The current theme is bringing to you those questions most asked, most pressing that people are thinking about, kind of akin to a Google search, but knowing that it's coming from someone talking to many home buyers every day. Be well. We'll talk to you soon.